Hello, everyone. Welcome back to another episode of Let's Talk Housing. I am Brennan Thomas, and today is a big one. It's our 50th episode, and it's been almost 2 years since this podcast became an actual thing when we made it reality. Whether you're a realtor, investor, buyer, or just housing curious, thank you for listening, sharing, and supporting this journey. It's been so much fun. And today we're celebrating by setting the record straight. We're tackling common housing market myths, things we've all heard but may not be true. So let's separate fact from fiction and maybe ruffle a few feathers along the way because, as we know and as we see almost every day, that is not a hard thing to do. But first, Steve, how are things in the Thomas household? How's everything going?
Great. Well, everybody is officially out of school. We have everybody. It's everybody's home. Yes. I actually had one of the kids come to me today and go, I'm bored, dude. Day one? My gosh. I would sleep a little. Can you imagine just being a kid? I think I'll sleep a little bit. Maybe I'll go outside, lounge around, maybe even jump in a pool. I don't know. This isn't hard. So we have summer vacations coming up. So some family trips, family outings, things. I can't wait. It's all begun. And starts like today was day one. So that's what's going on with us. That means all sports are done, which means a lot of sport camps are coming up, which means that they don't do a lot on the weekends. So we have our weekends free finally for a little bit because, man, we've been on in a bleacher someplace every single weekend, oftentimes both Saturday and Sunday. And that's just been how it is. So it's nice to have a little bit of a break. How about you? What's going on with you?
Well, I'd say that I'm recovering from the whiplash that mortgage rates have been giving me recently, where it's been very back and forth. Outside of that, I'm trying to get started with roller hockey. My brother Bryce and I, we tried signing up. Hopefully, we can get in the season in August. That would be so much fun. I just need something to keep me a little bit more entertained while I don't have all this soccer. But of course, there's international and got hockey and baseball, but nothing hits quite the same as I guess that club level in Europe. For me, it's just different. But outside of that, it's been pretty good. Just keeping up with the economy and real estate. It's been very all over the place. But Stephen, I'd just like you to shed some light before we dip into all the myths on what's happened with real estate and the economy over the past couple of weeks.
It's funny. I was looking at the all the inventory data. Not really much of a change lately. We actually, you now can see it. There was a tariff effect to housing, and it's gone now. It's like everybody's attention spans all yawn. You know what? The tariffs are. That's so like April's news. We're in June now. It's like we move on. We can't. Like our attention span isn't that great. So while it initially comes out, that's when everybody just blows their lid and overreacts and does a whole bunch of things. But of course, as we've seen, a lot of things change, and tariffs get the whole strategy changes like overnight, it seems. But when you're in it, it feels like a lot. But now, by the time we get to this, you know what? The tariffs aren't really affecting demand. Now we have demand curves that are pretty much identical year over year. And it looks like 2024's curve. It looks like 2023's curve. The pending sales demand metric that we utilize, the one that NAR does, it looks very, very similar. So it's not really changing there. We are seeing inventory levels. They spiked up like crazy with the accumulation of extra homes coming on the market. But that's been waning too. We're not seeing the same giant increases that we saw during the spring. So we'll have to see if that reboots in the next few weeks. It a lot of times does. It's just that initial distraction of people graduating, people making the summer plans in the first few weeks. But by the time we get the second half of June, we start to see a different churn where people want to take advantage of the summer market before it dissipates. So you get the second half of June, July, you get those increases. So the market with demand levels continuing to go down should see inventory levels go up, and then it will be slowing down as the year progresses. But over the last few weeks, not a big giant change, not a whole lot of change across the board. So that's kind of what's going on. And rates aren't helping.
No, they are not. So now we can dig into the fun part of this episode. So the first myth that I wanted to touch on is it's always better to wait for lower rates. Steve, what do you think of that?
Yeah, so uh, that strategy it just always makes me scratch my head, because when we went from 7% down to 6% last year. I mean, we were at 7.5% in April, and we made our way down all the way to 6.1% by the time we got to September. And those rates at 6.1%, and understand they made that move prior to the Fed ever doing anything. We were at 6.1% the week before they made their initial move in September. So rates will go where people think the Fed, where investors think the Fed should go. So that's what ended up ultimately happening last year. We got 6.1%. We were only there for a week, and we remained below 6.5% for 47 days. So we were only at 6.1% for a week. But can you imagine? We're at like right around just under 7%. If we made our way just down to 6%, then we saw a material bounce in demand in the fall market, which is not normal. So if you're going to wait for interest rates to be like, let's say, down at 6%, what you're going to see is this material change in the marketplace, especially the entry levels, where it will happen first, where you will see a bounce in activity that will be so great that if you're in one of those hotter price ranges, those will go first as far as multiple offers are concerned, multiple bids, and a drying up of the inventory. So you'll see the inventory dwindle down lower and lower in the entry levels, and then it will start to spread to other price ranges as well. But so if you're waiting, and now you're waiting until it's 6%, now you're writing offers that you might not get. If you're one of 5 offers on a house, who gets to win in that? One buyer. So that means 4 buyers have to go back to the drawing board. And that's kind of what we dealt with before. And that's kind of where the direction that we're going to go just when we get rates to finally cooperate. Because remember, rates haven't cooperated. We've been stuck at 7% pretty much since October of 2022. Couple times down a little bit lower, couple times up even higher. So, but average out, if you look at it over time, it looks pretty much like 7. And if you get that downshift where now for a while pretty much looks like 6, we're going to see a change in the marketplace. And now you've waited too long, and now it's going to be busier than what you thought. So that is the beauty of pulling the trigger now and not waiting till down the road, because down the road, if it comes down a full percent, you are at 7%, it comes down a full percent. By then, you can actually refinance a house, but you got in when there was plenty of competition among sellers, which is when I'd want to play. I'd want to play when there's competition among sellers. So that's and it proves to be right. That's actually, I pulled the trigger on purchasing last in 2019 for our own house, and it was a fabulous time to do it. It ended up being, we closed in October, the fall of 2019, pulled the trigger on that, and you know what? We had a seller that was more willing to work with us because there was more people that they were competing against. So that's what you have to keep in mind. Less competition among buyers, more competition among sellers. When do you want to play?
Very great analogy. So the second myth that I wanted to go over is something that we will, what feels like forever here. So the second myth is the market is going to crash like 2008. What do you have to say about these people who are constantly looking towards that?
Well, they can get their pom-poms out because I just did a housing debrief about it being a buyer's market. So technically it's now right now a buyer's market. Does that mean that prices are going to plunge like the Great Recession? Everybody's mind immediately goes to that, but that's not how markets work. You need a lot more inventory, a lot more supply, because if we're dealing with the same amount of demand and now we're placing more and more homes on the market and we're building more supply but same demand, it's applying pressure to pricing. However, across the United States, we're less than 1.5 million homes. Back prior to the Great Recession, starting in 2006. In 2005, we had 3 million. In 2006, 4 million. And it stayed at that, elevated at 4 million for 06, 07, 08. We're at 1.5. We need 2.5 more million homes on the market, and a lot of them to be owned by banks. So foreclosures and short sales. So it was like over half the market, 2/3 in many markets, were actually run by banks who are unemotional. Too many. We don't have that. We have strong housing stock, and it's run by a whole bunch of emotional homeowners that love their house and don't want to give away one extra penny. So pricing is very sticky. So you're not going to get the crash because it's just not the same makeup of the housing stock. The housing stock prior to the Great Recession in '06, we had 5% of the entire housing stock had negative equity. It's like at 0.2% right now. We don't have the same problems. There's not the subprime. There's not pick a payment plan. There's not adjustable rate mortgages that adjust every month. There's not a lot of fraud. There's not teaser rate adjustable mortgages. The list goes on and on. Higher FICO scores, better jobs, more down payments, more equity in housing. I could just keep on naming it forever and ever and ever, and yet people still expect it to be as bad as the Great Recession or something worse, which we don't have those kind of housing downturns. We had it during the Great Depression. We had it during the Great Recession, and in the Bay Area and Southern California, it wasn't nearly as big, but there was housing values coming down in those areas because of the savings and loan scandal caused by the housing industry. Any kind of downturn is not really caused by the housing industry. It's caused by elevated rates. That's it. That's the only kind of downturn that we have, and it's going to cause a little pushback in values aggregate across the United States being down like 1%, low single digits.
And for this third myth, that's for the first-time home buyers. You need 20% down to actually buy a house. Is this true or is this false?
Yeah, that's false. As a matter of fact, we did another YouTube on the increase in foreclosures, which we're going to get an increase in foreclosures of FHA, additional 60,000 by our math foreclosures, and they're all coming from FHA. And the reason that it's almost all of this negative, the foreclosure activity is going to come from FHA is because FHA allows for 3.5% down. So no, you do not need 20% down. Their requirements are a little bit different than Freddie Mac and Fannie Mae, the conventional loans. So that's backed by the government. These FHA are backed, and they require mortgage insurance, but you can purchase a home with as little as 3.5% down. And the funniest thing is, it's 80% of everybody out there has no idea about 3% down. I think for first-time home buyers, I think it's 97% don't even know that you can put as little as 3.5% down. So I think that might be the math on it. And so that you can purchase a home with very, very little down. There are programs for that. And you know what? These programs are even for people that they even accept people with more inferior credit scores. So now you understand why more of the foreclosure activity will come from the people that put less down and have more credit risk. So with that comes a increased number of foreclosures or people that are in default, that type of thing.
All right. And before we go into the next myth, let's take a moment to thank our sponsor who's raising the bar for property inspections across Southern California. This episode is sponsored by Josh Niehaus and the team at Lead Group Property Inspections. With over 40 years in the business, more than 10,000 five-star reviews, and coverage across all of Southern California, they've earned a reputation for being one of the most trusted inspection teams out there. They offer comprehensive home inspections covering over 1,800 items, plus specialized services like roof inspections, termite inspections, mold and moisture detection, and commercial property evaluations. Agents, you'll love this. They include a free repair pricing estimator with every inspection available through their exclusive agent tool. It's a game changer when it comes to writing repair requests or negotiating credits. They're certified, insured, available 7 days a week, offer bilingual inspectors, and even bill through escrow to make the process smooth and stress-free. So if you're representing a client or buying a home yourself, do what the pros do. Reach out to Josh Niehaus and Lead Group Property Inspections for peace of mind and next-level service. So whether you're a buyer, seller, or agent, check out Lead Group Property Inspections and connect with Josh Niehaus for top-tier service across all of Southern California. Call Josh Niehaus at 800-494-8998 to learn more. So myth number 4 is going to be a fun one. Now is a terrible time to sell. So we talked about buyers, but now let's talk about sellers. You just brought up how we are officially in a buyer's market. You made that debrief, which is going to be out last Friday when this is uploaded. What do you say about that?
Yeah, it, it's not like we've got this deep buyer's market where values are plunging, and you'll be chasing the market down. That's not what we're talking about. What we're talking about is a lot more seller competition. And part of the problem is there's a lot of people that come out on the market and they're ill prepared to come on the market. They're not listening to their real estate professional who's telling them all the bells and whistles and different things that they need to do to enhance the curb appeal, enhance the presentation of the home, and it's the properties that do have all the right things, that look super nice, that have all the bells and whistles, that are nicely appointed. They might have new carpet, new paint, and are priced well. Those are the ones that fly off the market. When we look at closed sales activity, even during the slowest of times, a major portion of the closed sales activity on a monthly basis are people that are successful within the first couple weeks of coming on the market. And the reason they have that much success that fast is because they look nice, and those get the most attention from lots of buyers and are priced right. So if they're priced right, look nice, a lot of buyers, it comes up in their feed, they jump on it. And it's not just one person that jumps on it, it's multiple people that jump on it at the same time. There's a little bit more sense of urgency on behalf of buyers. And some buyers go, yeah, I don't really have to go that fast on it. And then they go, well, I still want to make an offer, and it's too late. Because those are the kind of properties that fly off the market. So what I refer to it as, it's bullseye pricing. And for sellers, you can have a lot of success by doing all the things that need to be done to make your home stand out where it's nice. Turnkey, ready to go. A. B, you price it right. Bullseye pricing means you only get one shot at that initial price. It's taking all of the comps and putting them in one of two buckets. Either it's inferior to the property or superior. And based upon looking at all the different comparables and saying, would I buy this one? Is it better than mine or worse than mine? Better than mine, worse than mine. Put in those two buckets. And from that, you're going to aggregate all the different prices. You line them all up and you're going to figure out what your price is. Price it according to that, not according to listed data, according to pending sales and especially closed sales data, recent closed sales data, and you'll arrive at the price. You do that, you sell. For the most part, there are some markets that are a little bit slower. So some of them you have to arrive there and you have to wait a little bit longer. We're talking areas like Maricopa, Phoenix, and now Clark County, Vegas is really slowing down recently. So it requires this bullseye strategy, packing your patience. Because what happens for those people that have to reduce the asking price is we show that they actually net less. And the more that you reduce, the more that you have to throw away in order to be successful. I'm talking cash. So it behooves everybody to come out of the blocks and sell as quickly as possible by having your property totally dialed in with not only the way that it looks and it being turnkey, but with price. And you do those two things and you'll be doing yourself a favor. You'll actually have success.
So, on the topic of pricing, myth number 5 is Zillow says my house is worth X amount of dollars. So, that must be true. What do you say to the people that follow Zillow to the T?
You know what? You can't. They have Zillow. There's no way that Zillow or any other of these home valuation companies, and there's plenty of them on the website. We receive postcards that say, see what your home's worth. It is so easy to see what your home's worth, but they're all a little bit different. How can they all be a little bit different? Because they all have their own pricing models that they do. So now there's a little bit of discrepancy from valuation to valuation to valuation. And what can't they evaluate? Anything you've done to the house, if it looks really nice and you've totally turned it turnkey, it's got all these different upgrades that you did. And what else can it not take into consideration? A lot of different things. Let's say that you have a crack in the slab. Can't take that into consideration. Let's say that your house that you had tenants in it. The tenants didn't take care of it. They had a dog there, and the carpet's ruined, and there's holes in the walls and things like that. Doesn't take that into consideration. It's just really gives you kind of like this idea. It's kind of like looking at we have wind chimes in our backyard, or looking at a flag, and you can see how you can hear the dingling. I can tell you it's windy. I don't know exactly how windy it is. I can give you an approximation based upon how much my chimes are dinging or how much my flag is flying, that type of thing. But is it that accurate? Nah, you know what? You need to go property by property, and decide exactly what honing in your prices. These valuation things will never replace the ability to go property by property. How long is it on the market? All these different factors that factor into the value, and you have to be super careful. And I would spend hours arriving at the price. It's that important. Otherwise, you're going to spend hours upon hours upon hours, day after day after day, thinking about, gosh, am I priced right?
Now, before we finish, I want to on this last myth. Now we can switch back to buyers. This really has become more of a topic now that mortgage rates have really risen, especially to near 7% for what feels like 900 centuries. But the myth goes, are all cash offers unbeatable? What do you have to say about this sort of myth?
Yeah, you know what? Cash offers are definitely beatable. You know what? You meet with a competent lender, and I know plenty of really extremely competent professional, like 5-star level lenders that have been doing this for a long time, and they can dial in their clients. They're going to give them a pre-approval letter that is as good as cash, practically. And that is exactly how you establish it when you bring in an offer. And then there you have the same level of excitement as you know what your buyer's excitement is. As a buyer, you want them to understand that you are dialed in, you are ready to purchase this thing, and you are ready to go. The only thing that's standing between us now and closing is not we already got the approval. So now the house has to approve, has to appraise, and then B, we have to go through the inspections. Well, with cash, they also have to go through the inspections, and there's a little bit more of like, you know what, I'm cash, I can do what I want, that type of thing. There's a little bit more of that comes out of it. So to the point where it really it's not going to be as strong as somebody that's like, we're a family, we're purchasing this is our second home, we're growing, we can't wait to place our homes in the school, our kids in the school, that type of thing. That those kind of things sell at the end of the day. So if you show that you really want it, and you do everything, and you're constantly keeping up with it and saying, I really want it, I really want it, I really want it, and it just shows that there's motivation behind that, and you want, as a seller, somebody that's extremely motivated to absolutely get it closed. And at the end of the day, you show that, and you're as good, if not better, than cash.
All right. Well, in 50 episodes, we've covered everything from supply shortages to the psychology of sellers. But if there's one thing that we've learned, and you've probably heard us say this time and time again, it's that facts matter more than headlines. So misinformation spreads fast in real estate, and we are here to slow it down. Thank you so much for being with us through this journey, and here's to the next 50. Don't forget to follow, rate. You can turn on notifications, subscribe to YouTube, subscribe to our services. We are here for you. And share this with someone who could use a little less hype and a little more of the housing truth. Thank you very much.
Thank you.